Most gurus tell you that you need body closure above certain highs or below certain lows in order for your break of structure or your change of character to be confirmed. But here's the thing. In reality, there are a shit ton of break of structures and change of characters, and only few of them work. Which one to pick that works? That's exactly what we're going to be talking about in today's video. My name is Jason, and I've been a full-time trader for nearly 5 years, and I've been a professional trading coach for nearly 2 years, teaching and journaling hundreds of students, hundreds of them getting funded. And today, we're going to be talking about the difference between liquidity sweep or a proper break of structure. Make sure to stick till the end of the video so you don't miss anything. Let's go to the charts. Okay, so first things first. In order for you to be able to identify whether your break of structure is a proper break of structure or a sweep of liquidity, you guys need to understand that the market in itself is driven by proper FOMO. What am I trying to say here? You see, the bullish momentum or the bearish momentum, all of that is just a myth. What makes much more sense is by looking at the chart and focus on who are in control, whether the sellers or buyers are in control. Now, you see, you probably have heard of something called order flow, right? Now, what is that order flow? A lot of them will tell you that in a bearish market, the order flow is lower lows and lower highs. And in a bullish market, it's the higher highs and higher lows. But let me tell you this, it's not necessarily going to be like that, right? It's too easy. If we were to say in a bearish market, the order flow is just lower lows and lower highs, and a bullish market is just higher highs and higher lows. It doesn't make a lot of sense. Look at the current state of the chart right now. Do you see when the price is delivering higher, do you only see higher highs and higher lows? Be very honest to yourself. Absolutely not. You will still see occasional lower lows creating, right? Are those lower lows necessarily a change of character or a market shift? Absolutely not, right? In order for you to understand your proper break of structures, here are a couple of checklists to keep in mind before you mark them as a break of structure and which break of structure actually matters, where you don't need no body closure above certain highs or certain lows. All you need is a 0.1 pip of a wick closing above or below structure in order for your break of structure to be valid. All right, as you guys can see right now, we do have a couple of checklists here, only 2 of them. It's pretty straightforward. Here's the thing, right? It's a matter of muscle memory at this point where, you'll be able to mark your proper break of structures and your change of characters or market structure shift, whatever you want to call it, right? Where all you need is not a body closure, but instead a proper, precise break of structure markings, okay? And the first one is going to be an external sweep of liquidity. Now, here's the thing. If you still don't understand the difference between internal and external sweep of liquidity, highly recommend you checking out the previous video where we exactly deep dive into the differences between external and internal structures or liquidity. Okay, so the first step is to identify the external sweep of liquidity. Once external sweep of liquidity happens, it should be followed by an external break of structure. Let me show you guys how it will look like in a drawing, and then in a second, we're gonna go and look at the chart examples. Now, in terms of drawing, this is exactly how it will look like. Let's say in a bullish market, obviously in a drawing, all I can draw right now is higher highs and higher lows, but that's not how the market moves exactly. Okay, higher highs and higher lows. And then after that being created, if you were to mark your external structures, this is how it will look like. All of these are your externals. You want to see checklist number 1, an external sweep of liquidity, external sweep of liquidity, like that, a sweep of external liquidity. That will be the sweep. And then at the low, the price should react off of an imbalance, okay? After a sweep of something external liquidity, the price should react off of an imbalance, okay? Once that has happened, okay, it should then be followed by an external break of structure, not the structure that is going to be created somewhere here. No, absolutely not. We're not going to be using that. What are we going to use then? We're going to be using the external structure. Once the external structure gets broken, there you go. That's the only break of structure that you need that will actually tell you where the direction of the price is. Okay? These break of structures here, these are subjectives. Okay? However, this one here is objective. Why? Because with every sweep of liquidity, with every inducement comes its objective. Okay? Alongside this one, This is the sweep of an external liquidity or sweep of an external structure. The objective of this low here is to take the high, which means that now we're marking those breakout structures that are basically the objective of the market, making it very, very high probability. And in a bearish market, this is how exactly it will look like, where market creates lower lows and lower highs. Externally, you want to see an external sweep of liquidity, price sweeping something of an external liquidity, followed by an external break of the low. That break of the low is the break of structure that you need to mark. Anything else than that, it is going to be subjective, meaning that it is going to be lower probability of a break of structure, market shift, whatever. Okay. Now, here's the thing. You guys now might be confused that how do I know this one is not a change of character or market structure shift and this was a sweep of liquidity? That would be a really great question if you were to have, but hear me out on this one. There is something called efficiency, market delivering efficiently. Now, at the start of the video, what did I mention? I mentioned about the price driven by FOMO, that the market is driven by FOMO. When they see a huge spike towards the upside, we automatically think that, oh, the price is definitely going to deliver higher. But in reality, then it reverses on you. How do we know that? You see what I mean? Like, what I'm trying to say here is that everything here is driven by FOMO. Whatever the candlestick confirmation that you're looking for, the bullish engulfing, bearish engulfing, yada, 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 all of those are basically driven by FOMO. Instead, this one thing here will change the way you look at your quote unquote trend of the market. And that is by applying the concept of efficiency into your trading system. This is what I mean by efficiencies. Now, you see, the difference between efficiencies and imbalances is very, very huge. A lot of them out there think that inefficiencies are basically the same as imbalances. Absolutely not. Imbalances and inefficiencies are completely different. Now, when it comes to efficiencies in a bullish market, this is what I mean. Price creating higher highs, breaking the previous external higher high, makes a pullback towards the previous higher high, and then continues to make a new higher high. Basically something like this, right? Okay, let's look at this thought process. Market breaks the previous higher high, makes a pullback towards the previous higher high, proceeds to break the previous higher high. This pullback here, focus on that. That pullback should at least touch the previous higher high. Okay? Right after price breaks the previous higher high, making a new higher high, will confirm you that price right now is efficient for bullish. Okay? What does that indicate when price is efficient for bullish? It means that price has the tendencies to deliver and continue on delivering higher. You see what I mean? But when the price is delivering inefficiently, and when I say inefficiently, this is how it will look like in a bullish market. Well, price will break the previous higher high. The pullback will fail to mitigate the previous higher high. It will fail to do so, proceeds to create another high. Where if you were to draw a line, the price there basically is not connected towards the previous higher high. What does that indicate? It indicates that the price is inefficient, meaning that the foundation of this bullish price is weak, and it has a very high chance for the entire pullback to happen, okay, towards the previous efficiency that was created. But however, when the price is delivering efficiently like this, the probability of the price making a very deep pullback or reversing on you is going to be lower probability. So now, how do we connect this to our liquidity sweep strategy? And that is basically something like this. Once you see that the price is delivering efficiently towards the upside or towards the downside, let's say in this case, we're delivering efficiently towards the upside, yeah? It means that what? The foundation of the bullish price is very, very strong. What you need to identify is your external structures. Number one, identify your external structures. Done. Once you have identified our external structures. Number two, you need to identify your imbalance that comes after your external structure. Okay? It could be like this. That's your external structure, external liquidity. You have an imbalance just right below it. Okay? The probability of this imbalance holding on to push the price higher is very, very high. So now when you have something like this, price is delivering efficiently for bullish, okay? You have imbalance just underneath your external structure or your external liquidity, and price trades below that external structure there, you're not going to mark them as your market structure shift or your change of character. No matter what it is, even if body closes below it, it is still low probability for you to have this kind of thought process that right now price is bearish just because of this market structure shift. Absolutely not. All of that is just a myth. Don't trust me. Go out there and backtest this. You guys will see it. Once you see that the price has induced something of an external, price then proceeds to break an external structure. There you go. That's the only break of structure that matters. Everything else previously, the break of structure that has happened is lower probability. Okay? Now, this break of structure here is the objective break of structure, which is the one that is valid to be marked. Okay? Because technically speaking, most of you guys are marking your break of structures to find where the market is heading towards. Okay? And you see, when you have, let's say you mark this as your break of structure, automatically your thought process will be like this, that, you know what, I have an extreme order block and I would like to buy from that order block, having my stop loss below the structure. Okay? Let me tell you this, that thought process in itself is not enough. If your break of structure didn't have a sweep of liquidity previously, your break of structure is very, very low probability. Same goes with your market structure shift or your change of character. So next time when you hop on a chart and you try to identify your change of characters on the lower time frame for your entry model, wait for a sweep of liquidity. Okay, let me show you an example here. All right, so let's move on towards a chart example here. This would be a perfect example if we were to mark things out in terms of our market structure. Again, let me repeat it. If you still cannot identify between your external and internal, make sure you watch the previous video, okay? Now, you see, we're going to be marking our external structures while keeping in mind about the checklist that we had in order for us to differentiate between a high probability break of structures and change of characters. Okay, now let's move on and mark our external structures. Number one, in order for us to know whether it's a valid break of structure, we need to have what? An external sweep of liquidity followed by an external break of structure. Now, if you guys were to see this, right? Let's connect all of the dots here. What did the price do here? Exactly. Price delivered efficiently, yeah? For the bullish price here that we talked about previously. That's exactly what it did, right? Created a higher high, makes a pullback, touches the previous higher high, proceeds to break an external structure, creating a new higher high, making this price here efficient for bullish. What does that mean? What does that indicate? It indicates that the foundation of the bullish price is very, very strong. And now price has the tendency to continue on delivering higher. Okay. You see, all of the bullish momentum or the bearish momentum, all of that is just a lie. All of that, you see that bearish momentum is everywhere here. But why did the price reverse? You see, now when you try to connect all of the dots, now all of a sudden I'm not speaking gibberish. You see what I mean? Now let's look at this one. This was the sweep of external liquidity, because again, that's an external structure. Now, where is the next external structure? That would be the high. That is the only break of structure that matters. Genuinely, that is the only break of structure that matters. Does that mean that whatever is happening here, is that lower probability? Absolutely yes. Does that mean that this here, that the change of character that happened here or the market structure shift that happened there is lower probability? Absolutely yes. Now, you guys might also say that, but then this change of character worked. Absolutely. You see, here's the thing, right? It's a game of probability, right? What we need to differentiate is which one is higher probability, which one is lower probability. You can flip a coin and then try buy and sell using that flip of coin, and it could still work sometimes. You see what I mean? But again, we need to understand which one is lower probability, which one is higher probability. And the two checklists that I gave it to you guys, that is the only thing that can make your change of character or break of structure lower probability. Okay, let's move on towards the next example. Let's look at this. What did the price do here? You have an external structure here, right? You see this? Didn't price trade below here? Look at it. Price traded below, yeah? Body close. shouldn't this be change of character? And shouldn't you be selling from there? But then why did the price do that? Do you see what I mean? Now, all of a sudden, it starts to make sense when you start to question some moves here on the chart. It starts to make a lot more sense. Now, let me explain what is the thought process here. What did the price do? First of all, this is not a valid change of character because the high didn't have no sweep. If you guys think that this here is a sweep of liquidity, this here is a sweep of liquidity, and then that there is your change of character, then absolutely not. You need to understand the difference between a sweep of liquidity and a break of structure. This here is not a sweep of liquidity. That is not. In the near future, I'll be teaching you guys exactly how to master the inducements or the fake outs or the sweep of liquidity. I'll show you guys the differences in the near future. But for now, let's stick to whatever we're talking about today. And that is this here is not a sweep of liquidity. And this here cannot be change of character because there was no sweep of liquidity at first place. Okay. So if that is not our change of character, then what we can say is, again, what did the price do? Sweep an external structure. We have an imbalance just underneath it. That is the imbalance that will be used for the price to continue delivering higher. And that is exactly what it did, right? If you were to mark your external structures, look at this. What did the price do? Created a new high, created a new low. What did this low do? Induced an external structure, and now only it broke the high. Now, that break of structure there is the only break of structure that is valid, that matters. Okay? The previous one, it don't matter. This break of structure here, it doesn't matter. This break of structure matters. Why? Because previously we had a sweep of liquidity. This break of structure matters. Why? Because previously it had a sweep of liquidity. Okay. Now, if you mark it correctly, you will notice that the price will never ever trade below the low that you have marked. The low that created a sweep of liquidity. The price will not trade below that. And that's exactly what the price did. It never traded below it. Continue on pushing higher. Now, if you guys were to notice here, again, price here, you have price being inefficient, right? Because the price delivered higher. Never made a pullback towards this high here. Never did. What did it do? A deeper pullback. Okay. Bullish momentum, bearish momentum, still again is a myth. Okay. In future videos, we'll be talking about efficiencies, inefficiencies on a deeper level. But today, we only talked about which break of structure and which change of character that actually matters. That was it for today's video. Hope you guys learned something new. Stop being the exit liquidity, and I'll see you guys in the next one.